Hey, hello everyone. Thanks so much for joining us today for this year's Year in Planning webinar for businesses. So we have a ton of great info for you today, so let's just go ahead and hop right in. So here are requirements to qualify for attendance monitoring and CPE tracking. So to qualify, you have to respond to 3 out of 5 polling questions, and you must stay for a minimum of 50 minutes. If you have any technical difficulties, please send an email to elevatelearn@armanino.com and always include the session name, the date, and your poll response. And if you have a question or comment, submit via chat. You can also submit via the Q&A feature. If you do submit anonymously, though, we won't be able to reach out to you after. So make sure if you have a question that you want answered and we don't get to it live, that you submit it with your name. And then here are our learning objectives for today. So after this course, you'll be able to identify key provisions in the One Big Beautiful Bill Act and other new legislation. You'll be able to define year-end tax strategies around deductions, credits, SALT, and more. You'll apply a year-end checklist to avoid any costly oversights, and you'll recognize when to engage a tax advisor for tailored planning. And then here are today's presenters. I'll go ahead and turn it over and let them introduce themselves.
Hi, my name is Casey Pellick. I'm a tax partner in our privately held business group. For those on the call that don't know what held business or PHB refers to, it's the group that provides tax compliance and planning services to privately held entities, including partnerships, S corps, LLCs. We primarily work in mid-market and to high growth companies over a wide range of industries. I am based in our St. Louis, Missouri office, and I'm excited to be here today to share some insight with you.
Hi, my name's Katrina Perlowitz. I'm a partner. I sit in our Bellevue office and I'm in our corporate tax group, which focuses on large businesses. And I personally focus both on corporations and pass-through entities and S corps.
Hi, everybody. Kelvin So from tax partner in a Southern California office, also part of the PHB group that Casey was mentioning earlier. I have been with the firm for about 10 years now, and my specialty is in the professional service side firms and also for the entertainment practice. So looking forward to talking about all of this fun tax stuff today.
Thank you guys so much. So let's go ahead and do our first polling question to kick things off, and then I'll kick it over to our presenters to get started. So how far along are you in your 2025 year-end tax planning? Okay, and we'll go ahead and leave it up until everyone has submitted their answers. Okay, I'll give it a couple more seconds for anyone that hasn't responded to the polling question. Keep it moving. Okay. And we'll go to our next slide and we'll get started.
All right, I'll go ahead and kick this off. So as we get this presentation started, I just want to just quickly go out there and say there's about to be a lot of information that's going to be thrown out today. As you guys already know, there has been so much that has happened since July 4th, which is due to the One Big Beautiful Bill that we're going to be talking about. So I think for a majority of people on the call today, it's important to just say have a pen or a notepad. And if there's anything that strikes a chord or that sounds something that you are very interested in or something that you think may be applicable, take a quick note and then definitely reach out for questions after the fact, okay? But the most important thing we want to do today is to make sure that everybody understands that year-end tax planning is very important. As some of you may already know, tax sometimes tend to be an afterthought when it comes to after transactions are done and people reach out about the tax consequences. But the most important thing is it is important for everyone to start reaching out to your tax advisors now. Reach out to your accountants and your bookkeepers and make sure books are done correctly and accurately, and definitely just try to start the conversation. So 2 things you guys can do is call your tax advisors, and then the last thing is also check out our Armanino's year-end planning guide. It definitely will help out. Next slide. And the big picture, what changed in 2025? For most of you, may have heard on the news, there was a very small, simple bill that was passed on July 4th, America's birthday this past year. And as you guys all know, there was a lot of information crammed and packed into it in this very short amount of time. And a high level, there's going to be a handful of things we'll be talking about, but in regards to the actual bill, it modified spending for a wide range of federal programs. There was a lot of structural reforms that was done across agencies just to help with the administration's priorities. Ultimately, it raised the statutory debt ceiling, but the most important thing was that the big Tax Cut and Jobs Act that occurred in 2017, a lot of those were extended or just temporary. This bill made a lot of these permanent. So it's a lot of things that we're going to be diving into today, but this one big act definitely plays a big role in year planning and also for next year as well. So Casey is going to start off with bonus depreciation.
So I'm going to start off by saying I refer to the One Big Beautiful Bill as OBA because One Big Beautiful Bill is a mouthful if you say it enough. So OBA. So let's talk about some key changes under OBA related to bonus depreciation and Section 179. First, OBA permanently restored 100% bonus depreciation for qualifying assets placed in service after January 19th, 2025. This is a huge win for businesses investing in equipment and other depreciable property. Prior to OBA, bonus depreciation had been phasing down each year under the Tax Acts and Job Acts. Another one that's a mouthful. It was scheduled to only be 40% on January 1st of 2025. So there is a small window in 2025 between January 1st and January 18th where you can only take 40% bonus, but then starting January 19th, you can take 100% bonus on qualifying assets. Second, there was a temporary provision that allowed 100% expensing for new manufacturing buildings placed in service before January 1st, 2031. This creates a significant incentive for manufacturers planning facility expansions. And we're going to get more into this into the next slide. So I promise I'll give you some more details on this exciting provision. Last but not least, Section 179, the cap increased to 2.5 million beginning after 2024 and with a phase out when costs of qualifying property exceed 4 million. So not really much change other than inflation adjustments for 179. To give you a quick industry example, for a manufacturer, a firm that's investing in new equipment, the timing of 100% bonus depreciation can have a major impact on return of investment. Accelerating purchases could mean immediate tax benefits. So what you can do now, I know we're in the last month of the year, but you can review any remaining capital projects or things that you were thinking about buying. Determine if now's a good time to buy those and get those into service, or maybe next year is going to be a record high in sales, so you want that deduction in 2026. So just the timing of your purchases could have a huge impact. All right, moving on to what I was just talking about with the manufacturing. So let's take a deeper look into the temporary provisions surrounding the real property used in manufacturing. This is referred to as Qualified Production Property, or QPP. Historically, these types of buildings have depreciated over 39 years for tax purposes. Under this provision, certain manufacturing buildings can now qualify for 100% expensing, which is huge. But of course, you must meet very specific criteria. The first is the building must be used in manufacturing or production, not for administrative purposes. So think about building a new property. 90% of that building is going to be used for manufacturing your project. 10% is going to be office space for staff and exec. You would get 90%, as long as you met all the other criteria, 90% of the cost would be eligible for the 100% expensing right away. The 10% would need to be depreciated over its traditional life. Second, the original use must begin with the taxpayer. So you just can't go out and buy a manufacturing building that's already around and get 100% of the deduction. The construction must have started after January 19th, 2025, and it has to be placed in service by January 1st of 2031. And then finally, the property has to be located within the United States. So no one can, build a manufacturer plant somewhere tropical. It's got to be here in the United States. So this creates a huge opportunity for manufacturers planning expansions or new facility because the ability to expense these costs upfront can dramatically improve cash flow and return on investments. So, and of course, one last thing not on the slide is they are still coming out with the documentation, the application process, all of the stuff for QPP. So that is something that we're still working through, but at least they have the criteria set. So you can think about if this is something that is good for your business. All right, moving on to cover the changes for R&D and Section 174 expenses. So exciting news, which I think a lot of us were waiting for. OBA permanently restored the immediate expensing for domestic R&D expenditures beginning after December 31st, 2024. This is a major shift back to pre-2022 rules. Small businesses can retroactively expense domestic R&D that had been capitalized in between 22 and 24. They can do this by going back, by making an election and filing amended returns for 22 to 24. A small business is defined as a taxpayer whose average gross receipts over the 3 preceding years do not exceed $3 million. So it's an incentive for small businesses to get some cash back for taxes that they paid because we were capitalizing R&D expenses. For all other businesses, there's still some flexibility. You can deduct the unamortized domestic R&D expenditures all in 2025, or you can spread it out evenly between 2025 and 2026. So for firms that are approaching a loss position, allocating unamortized domestic R&D over 2 years could help smooth out earnings and preserve some valuable deductions. So there is some planning opportunity there. So if you think that is for you, reach out to your tax advisor and we can run projections for you. Couple of important things to note. Foreign R&D still must be capitalized and amortized over 15 years, so nothing changed with that with OBA. And then another important note that isn't a bullet point on the slide, but it's worth a mention, is the R&D credit and the Section 280C limitation regulation, try saying that 5 times fast, remained unchanged. So the calculation for R&D credit and limitation regulations did not change. The only thing that changed was you no longer have to capitalize your domestic R&D and amortize it over years. You get to immediately expense it. So that's all I've got. I'm going to kick it over to a next polling question.
Okay, so we have our second polling question here. What is your biggest tax concern heading into 2026? Okay, we'll leave it up a little bit longer so everyone gets a chance to answer. Okay, I'll give it a couple more seconds. It looks like almost everyone has answered. Okay. And then we will keep on moving.
Oh, one of the other sort of large business or big business parts of the OBA, I'm going to borrow Casey's terminology because I completely agree it's a mouthful, is the changes to 163J. So when 163J, which is an interest limitation section, first came in the Tax Cuts and Jobs Act back in 2017, we had started with an EBIT approach, meaning adjusted taxable income we got to add back depreciation, amortization, and then subsequently for the last few years, we have been unable to add those items back. So now we are going back to an EBITDA approach for 163J. Just as a reminder, there is a small business exception for these rules, and that is the same rule that Casey just mentioned for small businesses under 174. So it's average annual gross receipts of the 3 preceding tax years of 31 million. So it's an inflation adjusted number, but for 2025, I believe the threshold's 31 million. So for businesses that are subject to 163J, this is a huge benefit because, especially in the manufacturing industry, something that's heavy depreciation. And so for purposes of year end, doing some cash flow modeling around the new 163J limits, how the carry forward, if you had unused 163J amounts, might play into that. This could be a good opportunity for that, as well as the interaction of what decision you're making with respect to 174 domestic amortization and how that is going to be impacted in a 163J calculation where you are adding back amortization. So a lot of these elements are sort of combining together, which makes kind of a year-end forecast or modeling really essential. So the other item on 163J, not on the slide, but just worth a quick mention, is not for 2025, but starting in 2026, when we get to the international provision changes, items like GILTI and the Section 78 gross up are no longer able to be added back in the 163J calculation. So they must be removed when calculating ATI. So if you have foreign entities or foreign subs, just be aware that there's more changes coming starting in 2026. So next slide, please. Another, we'll say, party-driven incentive of the OBA was a large impact to energy incentive credits. And so if you are familiar with the Inflation Reduction Act back in the early 2022, there was a large expansion of energy production and investment tax credits. Those have been largely repealed or heavily scaled back as part of OBA. Specifically, vehicle credits, things purchased, those would have need to have been purchased prior to September 30th, 2025. EV charging stations, so the credit under 30C, those properties need to be placed in service by June 30th, 2026. If you've got solar and wind properties, properties need to be placed in service by December 31st, 2027, unless the beginning of construction date is in 2026, July 4th. And so that is a very definition that a lot of folks in that space are keyed in on. I would say we have an incentives and credits group that deals with this quite a bit. I deal with a lot of credits as well in what I do. So reach out to us if this is of interest to you and something that your business is focused on, because these placed in service dates, the beginning of construction dates, the safe harbors under the beginning of construction rules, all of those things impacted by OBA and very important in that space. Also, I would say across all credits, so some of the credits that had bipartisan support were expanded as part of OBA, but the common theme in every credit is these new foreign entity of concern rules and specified foreign entity investment rules. And so those are very important, and the material components aspect of those rules and the clawbacks with respect to those rules, which are really aimed at preventing non-US countries into partaking in the solar credits and all the other energy credits. Another important point, because there was a lot of talk about it, not really a headliner in the bill, but the transferability and direct pay credits largely untouched, other than being unable to sell to certain foreign entities. And so that was a win for taxpayers. Again, not a huge change from the current rules, but something worth noting because there was a lot of action around if those would be retained in the new law, and they were. So for those credits, and again, the direct pay credits, still part of current law. Internet changes. Most of these changes are in effect after December 31st, 2025. Noteworthy for year-end planning, because as you're looking at forecasted cash flows and making estimated payments into 2026, is that there were some not the overhaul to international tax that we had in 2017, but some really important tweaks to those rules as we go into 2026. Specifically for GILTI and FDII, those definitions have changed. So we have some changes to the calculations for GILTI. It is now net tested income. It's necktie or necktie is what some people are calling it. Those are impacted by, we no longer have these basis deductions in those calculations. So both GILTI and FDII in 2025, you have a reduction for qualifying basis property in both of those calculations. Those reductions are gone, which for GILTI, that increases your tested income amount that may need to be included. But for taxpayers who had taken advantage of a FDII deduction, that should increase your deduction on that side. So kind of some gives and takes. I mentioned the 163J interaction with GILTI before. That will now be removed from adjusted taxable income in the 163J calc. And then I think another important element of those rules is the sourcing under FDII. So if you're a domestic company taking advantage of sales to foreign customers, the sourcing under the FDII rules has become more taxpayer friendly. And final thing I'll mention on this is just be aware of the rate changes. So the current effective tax rate of 10.5% on GILTI income is now going to be raised to about 14% in 2026. So if you're contemplating year-end dividends from foreign subsidiaries, it may be more beneficial to take those dividends in 2025 versus 2026. So again, some kind of important year-end planning and monitoring in that space as well. Tariffs sort of outside of OBA, but also in the news of late at the Supreme Court, lots of interesting discussions around that. I do want to call out that if you're following the court and the decision there, just note that that is not, those cases are not applicable to all tariffs, just tariffs under that certain act. And so it's really important to understand which tariffs are affecting your industries. We do have some specialists in that space. And so definitely reach out to any of the panelists and we can connect you with that group about how to best identify the tariff kind of cash flow strategy going forward in the future, because even if we get what we'll call maybe a favorable business decision from the Supreme Court, that does not mean that tariffs are repealed, or that the increased tariffs just automatically go away. So still really important to be focused on supply chain and pipeline in that space. I think we now have our next polling question.
Okay, so here's our next polling question, our third one. So how often does your company engage in proactive tax strategy planning beyond just compliance? I'm going to leave this one up for a little bit longer. Okay, 10 more seconds and then I'll go ahead and close this one out. Okay. Okay. There's those answers up there for you guys if you're curious, and then we will keep moving.
For the people who said not doing anything yet, I would definitely call your tax advisor as soon as we finish this presentation, at least to get the conversation going. The most important thing is best case scenario, you have nothing to do. But worst case scenario, you know exactly what you have to do. So definitely something to be paying attention to. But today, I will be our SALT expert representative. We'll be talking about PTET, pass-through entity tax, for anybody who is not familiar with that just yet. Talking about the SALT deduction cap, which is state and local tax, if you also haven't heard of that just yet. And then also talking a little bit about Nexus, which is the economic and physical compliance challenges, which I think is one of the ones where there's a lot of creativity going into it, a lot of thought going into it. It's always worth a conversation. So we'll spend a little bit more time over there. But the most important thing I want to just address is these three things are definitely very important, not only for year-end planning, but just for tax compliance in the future years as well. So industry examples, if you're professional service firms or literally anybody any company that has hybrid workforces after COVID, where you have remote employees everywhere, customers receiving benefits of your services, any of those, you have even one employee in a random state. Those are all very important to be paying attention to if you haven't had that conversation just yet. So next slide, please. Pass-through entity tax, everybody's S Corp and pass-through favorite topic. History lesson during this fun bill passing on July 4th, when the initial draft legislation was drafted, the House of Representatives actually wanted to take out the PTET for service trade or businesses, which was a little bit surprising, but people like us as accountants and lawyers and the medical engineering was like, hey, wait a minute, that's not fair. So somebody over there on the Senate had our backs and was able to push it through. High level summary, pass-through entity tax is still here. Okay, obviously from a federal level, the PTET is still available on the entity level. However, it's still up to the state. The provision still varies state by state. Okay, and that's very, very important because as you guys may know, for the people who's been living in this already, that every single state has a very different rule. So for example, the people over there in New York, or people have offices or partners in New York, your PTET payment's coming in about 2 weeks or so, right? And for everybody else on the west side, on my side of town, for California, even though June 15th was the first initial installment, and we know the second installment was actually supposed to be due March 15th of the following year, we all know December 31st is the big one because we are all trying to potentially do a year-end projection to see if there's a potential benefit we could take in 2025 versus 2026. Okay. And I think for anybody who's on the call right now, who is, for example, a sole proprietor, is always worth a conversation to reach out to see is there any potential ways to potentially change the structure to receive this benefit. And you have to understand why when we jump onto the next slide. But before we do that, I also want to say, Katrina will talk about this a little bit later, but there has been a lot of people talking about C corporations. Do you go ahead and convert it to an S corp? Does it make sense to? What are the tax consequences? Or what about for the C corp side? Do you turn into a partnership for whatever reason? When it comes to tax planning and entity structuring, the creativity could be endless. Okay. But I think if it makes sense, it's something to revisit. And sometimes it's worth revisiting. And if there's nothing to do, then there's nothing to do. But this is definitely a big one, especially since we know a lot of the coastal states have high state taxes. Okay. So strategic planning, just want to make sure for the people in California first, make sure you guys made that payment that was due on June 15th. And for the people who did participate in the LA disaster relief, if you guys were impacted in that on any front, that just make sure those payments were in by 10/15 as well. And I won't be surprised if you guys, for cash flow planning purposes, that you guys may want to make another payment in December. So just be wary of that. Okay, next slide. The reason the pass-through entity tax is very important was back in 2017 when the TCJA was first put into place. Our current president and his administration put in the legislation to put a SALT limitation for $10,000. Okay. And for a history lesson, we all thought that was kind of crazy. But then some states tried to take it upon themselves and come up with their own ways to try to still pass down the state tax deduction to their people in their states. So they found a way to create this pass-through entity tax. And once they did that, I think a handful of us did not think it was really going to go through and get approved by the IRS, but they blessed it. Once that happened, we started seeing many other states start to do something similar. We're probably close to about 30 states now who do participate. So I'm not anticipating many states taking it away, but the reason that PTET was I feel like solely created was because of the state and local tax deduction limitation. Okay. But many of you on the call are probably wondering, hey, we heard about this 10,000 and we heard about this 40,000. So what does that mean? Hate to break it to you, but the $40,000 limit is depending upon your AGI. Okay. It's based on your modified AGI income limitation. There's a threshold that is put into place. If you are under 500,000, the 40,000 is applicable to you. Congratulations. However, if you get to 600,000, it reduces back to 10,000. You're back to square one. So that's why the conversation about the PTET benefit is fit if you're definitely looking into that. The salt cap is at 4,000 right now for a handful of for everybody under 500,000. The cap is supposed to increase 1% each year after 2025 until 2030, and that's the high level summary about the state and local tax. So for the people in California and New York, and the people who are still sole proprietors, still worth it to revisit because the pass-through entity tax election is still a huge benefit. Next slide. And last but not least, economic and physical nexus. And this is where I would say, if you guys have customers all over the country, or you even have customers who may be receiving benefits everywhere or in certain states, or you guys have offices in other states or employees in other states or warehouses or holding inventory in any other states, it is worth a conversation with our state and local tax team because the economic and physical nexus rules change for each state. So for the economic nexus purposes, it's based on your economic activity, depends on your sales revenue, and some states it's based on transaction volume, not just physical presence. So for example, some states would say, hey, if you made 200,000 or 500,000 in the state and our customers are here in our state, then we want you to file taxes there. And there's other states that goes, hey, 200,000 sales or 200 transactions in general. So if you're the e-commerce companies or if you guys have manufacturing companies with people out in different states, it's definitely worth a conversation. This is a very common issue for sellers and service providers. Okay, law firms is not as simple as wherever you perform your services are inside your office. Actually, some of your customers could be all over the place. So it's definitely worth a conversation for that as well. And some of you who have partnerships with partners who are in different states as well may constitute nexus, may create nexus in that situation too. And if there's creative ways to help with apportioning income, it could help them because there's no reason why we're going to try to just say 100% goes to California. We definitely don't want to do that. So economic and physical nexus is very important. The physical nexus regarding the tangible presence of office employees and inventory is most likely like a traditional standard, but I would definitely still make a call or ask us to ask for an introduction to our state and local tax team, especially because some of this stuff is very important, not only from income tax compliance, but business registration, local tax filings, all that fun stuff. And I know a lot of you guys are starting to receive those notices because every state wants a piece of their pie. So
if I can just add something here, I do want to say that we are hearing a lot about M&A activity picking up in 2026, right? Everyone's pretty optimistic that we're going to see even more PE activity that we've been seeing and kind of more deal flow. And I kind of have this, nothing kills your deal like state and local tax issues. And so really understanding your sales and use tax footprint and your income tax nexus and where you're filing appropriately. And even if you're making a business decision to not file in a jurisdiction, certainly the evaluation and documentation of that is really important, and it absolutely gets looked at by buyers. I cannot tell you how much this as a federal income tax specialist, I would love to say that, it's absolutely the state and local tax issues that are carrying the day here, I think.
It's always funny, right? Katrina is always like, hey, it's going well, it's going well, it's going well. We're almost at the finish line. But hey, somebody goes, what about your state and local tax filings? It always happens.
What about unclaimed property?
Yes.
What about traveling employees, hybrid workers, all those things that you mentioned? Very, very important to consider if you're looking at taking on funding or an M&A transaction in the next couple of years. Absolutely have this on your radar.
Yeah, it's not even year-end planning anymore. It's almost future planning as well, succession planning, right? So no, I think that's a very good point, Katrina. Thanks for bringing that up. All right, I think the next slide is a polling question.
Yeah, so this is our fourth polling question. So, which area best describes your business? Give it like another 10, 15 seconds. Most of you have answered. Just waiting on a couple. And we want to make sure you get your CPE. And again, you only have to answer 3 of the 5 polling questions. So if you have missed one, we still have one more left after this. Okay. Here we go. And then we will keep moving.
Okay, to me. All right, so we've talked a lot about business. So some of you on the call might be saying, well, I'm the owner. What are things I need to think about? So there are a lot, and we thought it would be best just to narrow it down to maybe a few. So know that this is not the full thing you guys should be thinking about, just a couple of the most significant or common ones we see. So the first one is the qualified business income deduction. This is the 20% deduction on qualified business income for pass-through entity owners. OBA made it permanent. So great news. There were a lot of discussions when OBA was in draft form of changes or limitations, but ultimately no substantive changes occurred. So great news. Second, and I won't go into too much detail because Kelvin did such a wonderful job talking about the benefits of pass-through entity tax elections, but they do reduce your federal taxable income, and that can create some significant savings for owners in high tax states, particularly New York and California. And if those, as owners, you're exceeding that $40,000 or $10,000 cap at the individual tax return. Another one is upfront or front loading your charitable contributions to help maximize tax benefits. So with the tax law changes that happened in 2017-18, a lot of us went and we were itemizing, and then the standard deduction significantly increased. So it was more beneficial for us to take the standard deduction. Well, by doing so, you lose the benefit of your charitable giving. Your tax benefit, not your overall benefit, but your tax benefit. One thing you could do is, if you've been taking the standard deduction for a couple of years, but you know this upcoming year is going to be a big year with a business or a large bonus, you could front load your charitable contributions by bundling all of them into 1 year. And you may be saying, well, I don't want to give 5 years worth of donations in 1 year. Well, you can take advantage of a donor advised fund, also referred to as a DAF. They make it extremely easy, and you get a deduction for when that money is contributed into the fund, and then you can distribute the funds to charity over time. So that is one way to switch between taking the charitable deduction for a couple of years and then itemizing in 1 year, maybe a big income year. Another thing to think about is, it's never too soon to start thinking about succession and transition planning. It's always good to have an idea, start those discussions, and particularly with OBA impacted our estate planning. So if you were thinking about gifting your business or a portion of your business to the next generation, OBA increased the estate and gift tax exemption to $15 million over a lifetime per person starting in 2026. It will be indexed each year with inflation, but this creates a great window for strategic wealth transfer planning. And similar to our state discussion earlier, Planning and discussions about wealth transfer are very, very important because you don't want to pay Uncle Sam all the tax dollars. You spent your life building up that wealth, and so let's pass it to the next generation or pass it on to whomever. So always plan, always have those discussions. And now I'm going to kick it to Katrina.
Okay, Katrina, do you mind if I say something quickly about succession planning before you get really nerdy with QSBS? Succession planning, no, great points, right, Casey, regarding from the owner's perspective and the personal side. But I saw about 48% of the people on here professional service related. And I just want to say in this middle market PHB side of town, succession planning is critical beyond year-end planning. Okay, it takes years to do it properly. I've seen some people put all their eggs in one or two baskets. This is supposed to be the future. Something happens, the firm falls apart. Okay. So I just want to just say beyond that, from the business side, it's definitely worth conversation to say, hey, maybe in 3 to 5 years, I want out. Maybe in 5 to 7 years, I want out. What should I be thinking about or talking about? Do I need to do these state tax nexus studies? Is that necessary? Just want to put that out there too, just because we're seeing a lot of that happen these days. Like Katrina was saying, a lot of M&A activity picking up.
And they're
So,
not just buying you and your brand, they're buying your business and the viability of your business. And so again, buyers, PE firms really thinking about the next generation of leadership in the business as well. So I think that's a great point, Calvin. I would also say don't forget about state estate tax planning. Sorry, I promise I can get it out. And there's still, I think, roughly 20-ish plus states that have a type of wealth transfer tax. And those exemptions, you may not have what would be considered a federally taxable estate, but you could very well have a taxable estate from a state tax standpoint. So be aware of that as well when you're talking about business succession and gifting. And that's kind of a nice transition, oddly, to qualified small business stock planning. So if you are an entrepreneur, if you are looking at an exit event on a 3 to 5 year horizon, one of the things we've had a lot of discussions around in year-end planning is entity selection and types of entity selection. And so if for those who are not familiar with qualified small business stock, it is a product of the 90s, one of the greatest decades, and it is an exemption. So it's a federal tax exemption on the sale of corporate stock that meets the requirements of qualified small business stock. And so it used to be that you held that stock for at least 5 years, and then assuming all the other qualifications were met, there was a $10 million per shareholder exclusion. It's actually the greater of 10 million or 10 times basis. So the minimum amount of gain exclusion is $10 million per shareholder in that sale. What OBA gave us was a much expanded definition of qualified small business stock. And so now the definition of a qualifying business, it used to be a $50 million valuation. Now we have a $75 million valuation. And for shares issued after that July 4th, 2025 date, there is now a $15 million per shareholder exclusion. And so again, if you're a small business and you're looking to sell in the next 3 to 5 years, there's also a partial exclusion after a 3 year holding period of 50%. And then it's 50% after 3 years, 75% after 4 years, and then again, a full 100% gain exclusion after 5 years. So we've been doing a lot of planning around if you are in a pass-through structure and you're reinvesting money into the business and you are looking to do an exit in 3 to 5 years, does it make sense to convert to a C corporation? We still have that 21% low tax rate, even though the QBI deduction is here to stay. That's still only getting you 29.6%. If you are an individual resident of a high tax state, a lot of times the business rate is lower. So California is a great example. You're 12.3 to 13.3% on the individual side, 8.84% on the business side. So there's the opportunity to maybe save some cash tax as you're planning for an exit, and then also go into an exit with qualified small business stock. There has been chatter that perhaps S corporations can start to qualify, that we will get a law change. It's very interesting. It is not currently happening. So it does need to be C corporation stock that qualifies for qualified small business stock. So again, if this is something that you're looking for, an exit, if you're doing estate planning, remember it's a per shareholder benefit. So if you have gifted a portion of the business, now with that gift comes the qualified small business stock attribute, and then that beneficiary will also receive the qualified small business stock exclusion. So it's a really powerful tool. It didn't get talked a lot about in I'll call it the early 2000s and in the 90s, because honestly, the long-term capital gains rate was coming down. The corporate tax rate was 35%. So it wasn't really seen as a motivating cash plan tool. That has really changed in the last decade. And again, OBA has just opened that up even more. We have a QSBS webinar taught by our brilliant team led by Tommy McCallister, that is next week. The link to register for that is in the webinar chat. So highly encourage you, if you're in that space, if you're contemplating maybe converting to a C Corp, it's worth your time. It's worth a listen. It's worth reaching out. I think on the next slide, we're gonna wrap it with some year-end tax hygiene. So again, looking at entity structure, a very hot topic right now. Year end is always a nice time to cut over on entity structure. It kind of is a nice clean cutoff for everyone. Looking at and getting ready for if you're required to get a financial statement review or an audit, checking in with your team to make sure that you've got good set of recent reconciled financial data, that you're well prepared to go into that, have a good timeline of when your year-end close should happen and when your data will be ready, getting in gear for your 1099 compliance and reporting. We did get the increased threshold in OBA, which was great. Again, we have a great streamlined process for that. It's kind of a one website fits all your needs. It's got all the information there. If you need help with 1099 reporting and compliance, we kind of have a one-stop shop for that as well. Reach out. Any of us can connect you to that group. And as far as if you are a public company, the new tax disclosures will apply to you. I feel like in the corporate tax group, I need to mention that. So if you're a public company, the new income tax disclosures will apply to you for your 2025 year-end reporting. If you're a private company, you have one more year before those disclosures are required for you. If you don't know what that means, give me a call and I'll walk you through it. But for most of that, looking and just making sure that everyone's ready for year-end reporting and compliance, especially more thing that we didn't talk about. If you are in a business and you pay overtime to your employees, right? We have the no tax on overtime deduction that's available to individuals. And so making sure it's worth a call to HR to make sure that you are prepared to do the proper year-end reporting. The withholding tables were not updated for 2025 for these rules, right? So a lot of your employees are going to be looking to get 2025 tax refund. And so just making sure that you are equipped and prepared to report that information. Same thing on tips to the individuals for W-2 year-end reporting. I think it's going to be critical. And then into 2026 as we do that. We hadn't really talked too much about payroll on this webcast, but again, as we talk about year-end planning, it's worth a call to make sure that payroll is handled, because I know how important that is to get that right and that be appropriate. Anything else, Kelvin and Casey, that I kind of missed on like getting ready for year-end in your mind?
I think you did a great job.
Yeah, there's one that keeps coming up these days regarding, I think it was not really OBA related, but the Secure Act 2.0 about the 401k catch-ups being now, I believe the catch-up amount needs to be a Roth, a Roth contribution instead. I would just call you administrator just to make sure that all your I's are dotted and T's are crossed. And in regards to payroll, that's a whole different monster on my side of town. I would say call your payroll companies, make sure that that's all getting ready to go. We know the whole no tax on tips, no tax on payroll sound good in the media, but there's still income thresholds on that side of town as well. So there's just a lot of moving parts. But if you don't know who to go to regarding that, we have a strong HR and payroll team on our business outsourcing team as well. So I've always said Armanino has been a huge one-stop shop. even the most important thing that I feel like it's not related to tax at all, but I think it's worth it before I talk about OBA is AI. I've been receiving a lot of conversations or questions about, hey, what are you guys doing with AI? Two, how can I implement it at the company? Or three, we're having a couple of people use it already. We're concerned about security. We're concerned about information. We're concerned about policies, making sure people don't abuse it, all of that, right? There's so much of that that is going around right now. We have an AI team as well that you guys can reach out to definitely have these conversations. But that's definitely a big one I would definitely talk about because I know I'll say I don't know how old I really am, but at the end of the day, I would say this AI conversation is probably one of the biggest, I think, changing things that we're going to be facing in our generation. This thing is not going to stop. So that's my AI spiel. But regarding the OBA summary, there's a lot of things we were not able to get to. And I think this is just a high level summary of some things that you want to just probably take a screenshot of, or make a note when you guys get the PowerPoint slides. And if there's anything that, strikes a chord, definitely reach out and we could talk about all of this as well. On the individual side, we do have another webinar that's going around too. So there's another link for that. We could definitely circulate. But there's just a lot of things that went into this bill. Katrina, were you gonna just chime in on something?
Oh, I think you've pretty well covered it. I was just gonna kind of give a shout out to in the same way that my doctor doesn't like it when I go on WebMD and then ask him questions. I would encourage you, if you are getting tax advice from AI, to certainly run it by your tax advisor. There's just because of how the learning model is working with respect to tax advice. I've seen a lot of misinformation, a lot of old information. So we get law changes all the time, right? And so sometimes you're not getting the most updated information from the tools. I think I use AI every day for tax for what I do, but definitely do not rely on AI tax advice given to you at this point. Certainly consult your tax advisor before you make any decisions. And so I think it's been a phenomenal tool. Totally agree with you, Kelvin. It's not going to go away, but for tax advice specifically right now, I think it's a great tool to point you in the right direction. Certainly consult your tax advisor before you make any decisions.
Yeah, that's a
Yeah,
great point.
yeah, no, I completely agree with you. I don't even do that with just taxes. You have to deal with everything regarding AI, just because the information is just too vast. But one last thing about this that I don't think I put on here, but I wanted to just quickly address. It's really small, but I thought this was just a really funny part of the OBA, was they would call it the no deductions regarding like your coffee or like I think it was meals for the convenience of your employee. All of that is something new. So your office snacks no longer deductible in 2026. Okay. I know it's really small, but it's important because your accountant or bookkeeper needs to probably create a new chart of account or a new account to take that into account because it's all probably blended between office supplies and business meals. So just make sure that there's a higher cost to some of these small perks, but it's interesting how all of this got put together into this one big bill. Next slide. I think it goes back to what we talked about when we first started, right? There's so much information, a lot of legislative updates, time-sensitive credits, a lot of tax hygiene that could be done, but just a lot of planning that could be done not only for this year end, but just for many years to come as well. So every industry is very specific to their issues, and with these laws, they're very, very specific. So I think the most important thing is, once again, call your tax advisor, reach out. If you guys don't know who to go to, the three of us are always here for as a resource to either just have a conversation or just to bounce ideas off one another. We can also make connections or to our resources internally as well. And the one thing that could be very helpful is to use Armanino's year-end planning guide, because when I look at it, there was just a lot of things that you guys could be thinking about. So just go through and just kind of just check it off and be like, hey, maybe I want to talk about this. Maybe this is applicable. And just to use that as a guide for your next conversation with your tax advisors.
If you heard something on this webcast and you want to just read more about it, the guide would be a great place to start.
Hey, thank you guys so much. So here's our final polling question. I'm gonna go ahead. There we go. So do you have our year-end planning guide? We also have an individual guide too. You can select that answer and we can get it to you after the webinar. Okay. I'll go ahead. Almost all of you have answered, which is great. And then I know we're running close on time, so we did get a couple of questions submitted. I won't go through those live, but I'm going to pull up the next slide here. Still a couple people submitting their answers, so I don't want to end it just yet. Okay. And here we go. So I wanted to pull up this slide here to just give our presenters email addresses. You guys are welcome to reach out to them with any questions you have related to today's webinar. Obviously, all three of them are very knowledgeable and willing to help. So reach out anytime. And again, we recorded this. We will also send a copy of the slides and the recording to those who attended and those who registered and did not attend. And then we will also share the link for the individual webinar. And then the guide link is in the chat. So a lot of great resources for you. So thank you everyone so much for joining. I'll give you 2 minutes back and we will talk to you soon. Thank you guys.
Thank
Thank
you,
you.
everybody.
Thanks, everyone.